Welcome. It's Monday, 1 o'clock, time for the Deal Doctor live stream. And today we have a special guest, Josh Nawrot with Northern Mortgage, that's going to help us address one of the main issues that we're running into today, which is getting sellers to list their homes. As you know, a lot of times when you meet with a seller, they say, hey, I can't list my home. I'm not ready to list my home because I don't feel as if I can find something. If my home sells today or tomorrow, I haven't found anything that I want to buy, and I'm not sure that I'll be able to within that framework of selling my house, getting closed in 30 days, and maybe having 30 days possession. And you know what? They're absolutely right. It is a challenge out there. And so sometimes you have to take the cube and you have to look at it a different way. You have to turn it upside down and flip the script, as I call it, because nowadays, years ago, I'll go back to that, sellers were afraid to go out and buy first for fear that they would have two payments to make for an undetermined period of time. They may sell their house now, they may not be, or buy a house now, and then not be able to sell their house for 6 months. Well, that's 6 or 7 or 8 months of house payments that they're making double house payments. Let's think about today's market. In today's market, houses are selling in a matter of hours and over the asking price. So if they have to pay a month, maybe two, in an additional payment, well, that's a small price to pay to have the security of having that home in place that they're going to buy, that they want, the one that they really want. So, how do you do that? Well, I'm going to turn it to Josh and let him explain it.
I love it. Hi, 5-star family. Josh Nawrot, Northern Mortgage. Super honored to be on with your 1 p.m. live stream today. Thank you so much, Don and the leadership team for having me out today. Don teed this up absolutely perfect. We are running into the same thing over and over and over. There is a log jam in real estate right now. Sellers aren't selling because they're scared. That's the bottom line. Sellers know that the market is moving quick. They see the Facebook feeds of agents posting different things on how fast houses are selling and how many offers they got and how much above list price. And, to a current seller, that can scare them. Because it's not a matter of if their house is going to sell, but how fast, but more importantly, where are they going to go? We don't want to be homeless. I don't want to move back into mom and dad's basement. I don't want to, put an RV, in a campground, for a season and live in there. They're scared. So what do? They kind of hunker down and stay, in their current spot. We are seeing right now sellers stay in their house longer than they ever have. Used to have been a stat where it's about every 7 years people would move. Now that's gravitating upwards anywhere from 10, 12 years, possibly even pushing longer. So we saw this trend about 2 years ago, and we crafted a program called Equity Forward. We went through all the trademark steps to get it trademarked. It is Northern's, it is ours. I know that there's a few other imitations of that product out there, but this Equity Forward is ours. And we're going to rip through a couple of slides here that we put together. Super short presentation, super short commercial, but really this is designed to help you guys land more listings, help your sellers move, and do it in a non-contingent way that they're going to help them win. So if you guys have questions, Don's got a live stream of questions going on over here. Pop those in. We'll be answering them, but I think we're going to get it kicked off. So Equity Forward, here we go. So Northern Mortgage, we're super local. Everything is done right here in West Michigan. We work with a ton of 5-star agents, both on the buy side and the sell side. We love you guys. Michigan companies work with Michigan companies. I love it. I think it's fantastic. Privately funded, local handpicked appraisers. That's a super hot topic right now. Appraisers, making sure that they're the good ones heading out there. How many of you guys have had a fight with an appraiser recently? I know, is not real fun. And then crazy fast closings, we're averaging about 25 days right now. So what is equity forward? We get this question asked a lot. Equity forward is ultimately where we grab a chunk of equity, we pull it forward to their new purchase, and we can use it to cover down payment, closing costs, and this new thing called appraisal gap coverage or appraisal gap guarantee. Benefits to the buyer is it is a stronger pre-approval. It can be anywhere from 10 to 30% down. Down payment and closing costs are covered. We set up the loan correctly, potentially no PMI. It's fast, simple, and easy, with Northern Mortgage. So we started seeing this trend, like I said, last couple of years where all of these current sellers, they're making more money. They've paid down their debt. They've grown in their careers. Their family sizes have grown, and now they're outgrowing their houses. They want to move, they have motivation to move, but they're not really sure how to get from point A to point B without having to go through this whirlwind. You guys and gals see it when you're on listing appointments. Hey, I would love to list my home, but Equity Forward can help fill that in. Hey, let's take a look. Let's see what your options are out there. The biggest question I get asked on a daily basis is, Josh, sounds like a bridge loan. I think it's a bridge loan. Is it a bridge loan? It kind of sounds like it. So first off, it is not a bridge loan. A traditional bridge loan pays off the first mortgage, grabs a chunk of equity out, and their new house that they're buying jumbles it all together in one big loan. The tough thing about this, it's scary. It's a scary high payment. We're talking it could be $3, $4, $5,000 a month. We took over a deal not too long ago, different institution, and that was the main reason why the buyers were scared. Equity Forward is a simple second loan that we put on their house. It's interest only. We do not draw on it until the day of closing. And that's huge. We don't touch a first mortgage. People are very protective of their first mortgage. A lot of times they have a great rate and a super low payment. Equity Forward, easy, and then we pull that forward to their new purchase. Bridge loans have higher rates, payments, more red tape to cut through underwriting. It's not consumer friendly. Words like bridge loan have immediate negative connections with clients. When we're doing the case study on it, bridge loans were not well received out there. I know some people do them and they do them well if they really understand them, but for the general population, bridge loans are really tied into just a bad vibes, negative connotation, words. So we completely reframed it, repackaged it as Equity Forward. So who is this program for? Ultimately for homeowners that have been in their home for 2 or more years. We're seeing a lot of these homeowners that have been in their home for anywhere from 3 to 7 years. They've got so much equity right now. It's huge. We are seeing sellers have a lot of equity, but not savings. So when we're asking, hey, how much is in your checking and savings account? They're like, man, $2,000, $5,000. The guys, they've been paying off debt. They've been doing a great job. They're making more money. They want to move, but they need to move, and they're scared. So here's an example of a recent one that we just did. Owns the home for 5 years. Home is worth $285,000. I have no idea how much that house would sell for in today's market now, probably more. Owes $170,000. So we were able to Equity Forward in this example, $60,000, help them buy before they sell. And then they still have money left at the end of the day to pay commissions and closing costs. We go up to 80% of what the house is worth. There's no appraisal needed on Equity Forward either, which is big. We're really relying heavy on you guys, our partners, our realtors, going, hey, how much is it going to list for? What's it going to sell for? Send us the CMA. Appraisals all over the map. AVMs, automated values are all over the map. Zillow valuations are all over the map. So we're really relying you guys heavily on this. What are you going to list it for? How much is it going to sell for? And then we kind of base the numbers on that. So AVMs, automated values, we just kind of covered that. These are all over the map right now. We're really pivoting back heavily to our real estate partners on this. So here's the quick elevator pitch on Equity Forward. Equity Forward allows you to grab a chunk of equity, pull it forward to a new purchase, which allows you to become non-contingent and compete. Down payments covered, closing costs are covered, appraisal gap coverage is now able to be rolled into there, all while touching $0 out of your current checking and savings account. That's huge. Don, what thoughts do you have as I'm rambling on here?
No, I want you to continue to, well, you're doing very well. I wouldn't call it rambling. I think this is great information.
Yes.
So.
Are you guys getting a lot of info so far out of this? Awesome. All right. So really, I want to open this up to questions. That's kind of the 30,000 foot view of what this program is. It really is designed to be easy. It really is designed to ultimately be a very short-term item. This is not meant to be, let's use equity forward and, make payments on this forever. We're really using this as a short-term, almost a gap to fill. Not even a bridge, but a small gap, because houses are selling quick. Days on market are very small, and we realize that. That's why we're not making clients go through the whole traditional bridge loan process.
I'll be the first to I'll ask a question since
Fire away.
I haven't seen one come through from Dom. He gives me a little high signal to let me know that there are questions. So let's take this example. I've got a condo. I live in a $175,000 condo. I've got about $100,000 equity in that condo. I happen to know this because you refinanced this condo. Thank you very much.
You're welcome.
So, anyway, if I decide that I'm going to go out and buy a $250,000 house, I'm tired of condo life. I decide that I'm going to go out and buy a $250,000 house, and my income supports it. I have this chunk of $100,000 equity. How does that $100,000 break down in terms of down payment, closing costs? And let's throw in an appraisal guarantee. Let's assume for a moment that, what was the number I said, $250,000 house?
Yeah.
Well, let's make it $350,000 because that sounds more fun. So anyway, a $350,000 house, income supports it, all of those things. Now, that $100,000, how does that break down in terms of closing costs, and what do I have left to do using an appraisal guarantee to win? Because that's one of the major reasons that buyers are winning out there.
Yeah, that's a great question. So we are really, really good at working with your buyer's budget, or in your case, your $100,000, and trying to craft the strongest offer possible. I feel like we're on the phone every single day with our buyer's agents going, we have this bucket of money, how do we use it? Now, the first thing I do is I rely heavily back on the agent going, hey, how much appraisal gap do you think we need? I think appraisal gap coverage is going to be here to stay for a while. I know there's a lot of deep feelings on each side of the table or another on it. My thought is if you're bidding $1 over list price, you probably should have some sort of appraisal gap in there. It's kind of the new muscle behind the offers. If you remember a couple of years ago, escalation clauses, they can escalate $100,000 above list price, but when the appraisal comes back down, the seller's upset. They thought they were getting more money. The buyer knows that the house isn't going to appraise. So appraisal gap is here to stay. In this example, on a $350,000 purchase, I'd probably craft it 20% down, no PMI, so that's 70. I'd probably use, a good chunk of that money, for appraisal gap coverage, anywhere from $10,000 to $25,000 potentially, and then make sure that closing costs are also wrapped in that bundle. So we are going to maximize that $100,000 so it's best for the client and their payment, the appraisal gap coverage, and the closing costs.
Cool. I hope that helps because it's really, really important. Let me back up, give you a little bit of history. In 2005, we saw property values peak. And a lot of people believed that the market was overpriced at that time. We had a lot of building going on, a ton of building. And a couple of years later, in 2007, there began to have rumblings in the marketplace about the uncertainty of the loans and how they were being bundled and sold off in the secondary market. Sure enough, in the summer of 2008, the economy crashed, and we saw home values plummet. So the empty nester, or let's say baby boomer, who was planning to move out of their homestead, had accrued a lot of equity in their home, maybe even had it paid off, and all of a sudden the home value was cut in half. Literally, they went from $400,000 to $200,000, and they had virtually no equity in their property, so they stuck it out. Now, many years later, we're faced with a situation where they have not only recouped that equity that they had back in 2005, but they've actually gained even more equity. So they may be sitting on $300,000 or $400,000 worth of equity because they've been making payments all along too. They may be sitting on $400,000 worth of equity, wanting desperately to sell and downsize or relocate or get a place here and another place in the South in a warmer climate for the winter. There's a lot of that out there where they're simply scared because they're afraid they're not going to be able to find what they want after they sell their house. So using a product like this, you're going to be able to lock them into not only buying a house, becoming their buyer's agent, but then becoming their listing agent as well. So it's a really, really powerful product. I got a couple of questions from agents. Do you have any co-marketing available, materials available?
We do, yes. So we have a great flyer that can go in your listing presentation folder. It's got our picture. We can throw your picture, 5-star logo, everything on there. So yes, we can put together, some co-marketing on that. Couple of questions that we do get. Josh, can I still write conventional on the purchase contract? And the answer is absolutely yes. This is a normal conventional loan with an equity forward add-on. Equity forward is funded by Northern Mortgage. It's not a program. They're not running out getting home equity line of credits and dealing with different institutions. We started that early on, and then we had to bring the funding for that back in-house. Some of the other imitation products out there, there's lenders telling clients, hey, go to your bank and get a home equity line of credit. Go to your bank and apply for this. The tough part about a home equity line of credit at a bank is those loan officers are getting smart. They're asking your client, what's it for? What are you doing? And we don't want your clients lying or being dishonest saying, well, it's for home improvement or debt consolidation, when really they realize that they're grabbing their chunk of equity to pull it forward to a new purchase. The loan officers at those banks and credit unions do not want to do all that extra work to have that home equity line pay off sooner, and we don't want your clients creating mortgage fraud or being dishonest. That's why we brought that program, funded it internal, took it to our board and said, listen, we need to allocate funds for this because this is designed to be very short term. Another question that we get is, Josh, how long can they have this equity forward out there? This is designed to be very short term. We want them getting their new home under contract, and then we want their current home listed with an agent. That is a requirement, with an agent, not for sale by owner, not part of the program, listed with an agent within 1 to 2 weeks after. So we want their home ready to list, showroom ready, pictures dialed in, but we want that new purchase under contract, offer accepted, non-contingent, and then we want their current home listed right away. We ultimately want these dominoes marching, back to back. So we close on their new purchase, non-contingent, and then a week or two later, we're closing on their existing home, your listing. And we do make that a requirement. The home does need to be listed with an agent. We want to protect your transaction. We want to protect the amount of money that we have out there at one time. And ultimately, 2 paychecks at the end of the day is better than 1.
So let me get this straight. This is only offered to people who are going to list their house.
Correct.
So they don't get the option of being a FSBO.
No.
Is that not great? I mean, I think it's a great package to be able to go out and talk to sellers about helping them buy their next house, the one that they want, the one that they've dreamed of, whatever that is. And then also saying, by the way, this is a package deal. I'm going to help you buy a house, but I'm also going to list your house. Now you as the agent are taking control of the market out there rather than the other way around, having buyers or sellers control the market completely. So again, it's a way of flipping the script in order to address a changing market, a market that has changed and is going to continue from all indications that we have. What's the interest rate on this? We have a question from Krista. What's the interest rate on this program?
Krista, great question. So we do not draw on the equity forward until the day of closing. So house gets under contract, closes about 30 days later. We want their current home listed. These are running back to back to back. The interest rate is 4%, interest only, and it runs daily. So really, most of our clients are only paying between 7 and 14 days of interest, which is very, very little. On a $50,000 home equity, on a $50,000 equity line, I mean, the minimum payment on that interest-only 30-year is very, very low. So that's why banks and credit unions don't like the home equities that pay off quick, because there's no money made on the interest. This is designed to be a loss leader for us because we want that conventional loan. We want to peel that away from the bank, the credit union, the online lender, the competitor. We lose money on the equity forward portion, and then we gain their purchase money mortgage on the front end. It's a great package deal.
Amber has a question. So does equity forward just get paid back at closing? Well, actually, you just answered part of that. It just gets drawn upon at closing, in fact.
Yep.
Or is it all rolled into one payment with their new home?
Great question. We are keeping these worlds separate. Their existing house, we're not touching their mortgage. Their new conventional mortgage that they're purchasing over here, we're setting that up normal. All we're doing is this little add-on in the middle for equity forward that's attached to their first. So at closing, their main mortgage will get paid off, equity forward second will get paid off, and then everything is set up correctly for them moving forward.
Now, I know that there are agents out there that are still thinking of this, no matter what you say, are still thinking of this as a bridge loan. So help me reinforce that this is in fact not a bridge loan and why. You had a screen up, maybe we could go back to that real quick, because I think that's a really important aspect of this, which is different, and the sellers / buyers need to be aware of how it's different from a bridge loan.
Absolutely. So we have to get more creative in this market. I mean, you guys as agents are working harder than you ever have. I heard a story just last week of an agent going to a listing, and those sellers sat down and said, hey, we're interviewing 4 or 5 different agents right now. It is getting fiercely competitive, both on your guys' end of the business as it has been for many years on our end of the business. We're in the trenches, with you guys and gals every single day. We feel the pain. We feel the pain when the offers don't get accepted. And this is a great way to give you, as Don said, a leg up out there, something different that Keller Williams doesn't have and all these others. We're not rolling this out globally. Grar came to us and said, Josh, we want to roll this out. This could be great. And we said no. That ruins what we're ultimately about, which is a great client experience, great communication, and this cannot be rolled out to everybody. 5 Star is one of our top partners. We do a ton of business with our local agents. So this is why we're rolling this out, to you guys on this. Back to the bridge loan. Bridge loans have higher costs and higher interest rates. That's number one. Guys, we are in Dutch West Michigan. People do not want to pay $1 over anything that they have to. They do not want higher rates. They do not want higher costs. But most important, a bridge loan is combining that first mortgage, the equity out, and their new purchase all together as one big loan. And then it breaks apart as things happen. We're leaving everything alone. We're setting up their new purchase mortgage right. We're leaving their current first mortgage on their current house alone. And it's just a small little gap that we fill in between. Equity forward, grab a chunk of equity, pull it forward to their new purchase. Fast, easy, simple. People will do it because it is fast, easy, and simple. If it's complicated and higher costs and all this stuff, they don't want to. They will stay put. They will not list their house. They'll figure it out.
So, when it sounds too good to be true, it very often is. This sounds too good to be true. I have an agent asking, what's the downside?
Yeah, that's a great question. So ultimately, and this is really any market, is if their house is not sold, they could be doubled up on payments. Let's unpack that real quick. So we're in May. If a house gets under contract today, we're not closing until the end of June. End of June closing is an August 1st payment for their new property. So we're underwriting as if they're going to keep both houses. This is not a hedge bet. This is not, hey, I hope and pray that their house sells. As we know, some houses do sell quick and other houses might take a minute longer. So really the only con in this example is if you as the agent are not able to list, sell, and get their home underway, they could be doubled up for payments in August. And we're very transparent with them. Yes, the market's moving quick right now. Yes, there's opportunity to sell their home quick now. Markets can change and shift at any point, and we're constantly watching that. It's very, very busy right now. Could that change as we roll into summer? We're not sure. Nobody has the crystal ball to predict, but at the end of the day, we've taken on a lot of risk as the lender. We're underwriting the full package. If they don't qualify for both houses, we tell them, guys, equity forward's not the right option for you. Let's keep moving on. Let's get your house listed. Let's figure out like a rent back. Let's talk with your agent and craft some options to get you from A to B. But yes, the biggest downside is, could he be doubled up on payments August 1st? The answer is yes.
So if a seller is holding back, hesitating, because they're afraid they can't find the house or condominium that they want, they're holding back, and an agent walks in and says, well, your house is worth $250,000 or $350,000. And in reality, the house is worth $175,000 or $200,000. Now we've got a problem.
Yes.
Now we've got a problem because the agent and maybe the seller, maybe it is sourced from the seller, but the seller may say my house is worth $350,000 based on the one down the street. So in order to make this work and not put your sellers in a difficult position, you need to really know the market. You need to know what the real value of that property, the selling price is going to be, and you can't guess at it. So, but if you do know the market well enough, and your CMA is done very carefully, this is a great program to get over that obstacle of saying that we hear all the time, I don't want to sell because I'm not going to be able to find something that I want after I sell, and I'm going to be homeless, and I'm going to be living in an RV, probably on the lake, so I don't feel a whole lot of sympathy. But anyway, this is a great product, and I hope that it will get all of us to look at this market and find solutions to what we're experiencing right now, which is working for buyers and running around writing a bunch of offers and not winning. We've got to find a way to break that log jam, as Josh called it. We've got to break that log jam and get some inventory out there, and this is a great product to do it. So
yeah.
Thank you for joining us.
You betcha.
Appreciate it. Little bump.
Thank you so much, 5-star. And if you guys have more questions, feel free to reach out to us. We do have some co-marketing available.
We got one quick question here.
A couple more questions.
David Van Dam says, will the equity loan be a permanent second loan? If so, what would the interest be?
Yep. So once again, equity forward is a second loan that we put on their current home. So when they get their new home under contract, we want their existing home listed right behind it. When the listing home goes to closing, the first mortgage is paid off, Equity Forward is paid off. It's designed to be very, very short term. So we look at all options. Once again, Equity Forward's designed for the move-up buyer. It can be used for the move-down buyer, but really the majority of cases, it's being used for the move-up buyer right now. It's short-term funds to help kind of, bridge the gap, except we're not calling it a bridge loan.
So the permanency of this second loan is really dependent upon your ability as the listing agent to be accurate on the sales price. It's as simple as that. So
we also underrate that loan too. So we are looking at the agent's list, CMA. We're doing an AVM on it as well. We're trying to be very careful with these funds. If the CMA and AVM says 250 and you're listing it at 450, we're going to see it. These loans are underwritten simultaneously, clean conventional, Equity Forward add-on. We're calling this an add-on because people think that it was something completely different. Equity Forward, grabbing a chunk of equity and simply pulling it forward as if they've already sold their house.
again, if you have additional questions, Josh has provided his contact information. We'll be putting it on the link here, the Deal Doctor link. I thank you all for joining again. I hope this gives you another way to think about the market and how to make money this year by listing homes and helping them find new homes. And we'll see you next week.
Bye, guys.